4 years ago, Lehman Brothers collapsed and accelerated the global financial crisis. The U.S. was already struggling when the bank went under and went into recession shortly after. So after bailouts and new regulation, how's the economy been doing? In the year after Lehman filed Chapter 11, the U.S. lost almost 6 million jobs. Since then, we've recouped about half. And Wall Street's gotten smaller. There are 19,000 fewer Wall Street jobs, and there are fewer big banks after Lehman fell. Merrill Lynch was acquired by Bank of America. Washington Mutual was swallowed up by J.P. Morgan, and Wachovia was bought by Wells Fargo. But by assets, big banking has gotten more top-heavy. The top 5 banks are worth $8.7 trillion. Back then, they were worth only $7 trillion. Bigger now than then. Wall Street is more regulated. The Dodd-Frank financial reform, one of President Obama's key pieces of legislation, established the Consumer Financial Protection Bureau. It ends bailouts for banks that are too big to fail, regulates complex financial instruments, and monitors and stops threats to the financial system. That hasn't stopped banks from making risky bets, to be sure, but most of the provisions of the law have yet to be put into place. Finally, the economy is growing instead of contracting. The economy grew at a rate of 1.7% in the second quarter of 2012. During the quarter Lehman collapsed, GDP contracted 3.7%. While Lehman's bankruptcy didn't cause the financial crisis and its painful aftermath, it was one of the big dominoes that set it into motion.